Hello, everyone. Welcome to another episode of On the Record with your host, Tone Vase. This is a really special episode. I've really wanted to talk to my guest for a really long time. I ran across him on Twitter probably about a year ago. Really like what he had to say. It was amazing finding a bigger Bitcoin maximalist than myself, but I did manage to find one. So this is going to be a great interview. And of course, I am talking about Saif, you've recently published your book, The Bitcoin Standard. I just finished the book yesterday, which is why I was like in a rush to finish the book before this interview. It's also why I delayed this interview until I actually finished the book. It was excellent. It's an absolute must read. So Saif, welcome to On the Record with Tone Vase.
Thank you for having me, Tone. It's a pleasure to be here.
Great. And tell us a little bit something about yourself. I know you are a PhD economist and you are a professor as well currently.
Yes, I'm a professor of economics at the Lebanese American University. I've been there since 2009. Around that time is a little earlier than that is when I started becoming interested in Austrian economics, and that's how I heard about Bitcoin, because Austrians are kind of interested in Bitcoin because it's sort of as you may have heard, it's related in its monetary properties to what they would see as hard money or sound money or free market money. And so I've heard about Bitcoin quite a long time ago. I've enjoyed learning more and more about it over time. And over time, I decided to write a book eventually because people kept on asking me more and more about it.
Awesome. And it was absolutely excellent book. The first, I believe, 8 or so chapters or 7 chapters focused specifically on money and economics in general, barely mentioning Bitcoin at all. And then you talked a lot about Bitcoin in the later chapters. I really, really liked, chapters 13 and 14, where you explained how Bitcoin doesn't really have any competitors within its own crypto space. I thought that was pretty concise. I mean, I've been trying to explain this for years, and I have resorted to, 10 hours of video a day. You did an amazing job by getting it done, in about 60, 70 pages.
I suffered through a lot of these videos. That's why I credit you with learning a lot about this difference. I mean, I always was not always. I have to say, no, there was a time in which I thought some shitcoins could serve a purpose. But I think, after a while, your videos were quite helpful in just, coming around to it. The only shitcoins that don't look bad are the ones that you haven't researched yet. As soon as you start researching and looking into them and how they're done and how they work, you realize, it's completely pointless. And so, I don't understand the sort of mental fortitude and willpower you had to sift through. What was it? You did 10 episodes on 10 shitcoins or 8?
Like crypto scam, and crypto scam is coming back. I recorded a crypto scam episode yesterday. It was another Ethereum episode. I'm gonna line up another Ethereum. Crypto scam is coming back. Some of those coins are still around. And thank you. That's I'm really happy to hear that you've watched some of my earlier work. And in addition, I liked your answer. The only shitcoins that don't look bad are the ones you have not yet fully researched. That is absolutely amazing answer. Because what I was going to say was your book is going to cause me a bunch of problems in about a year, because I already see it coming. Because in like a year or two, some new people are going to come into the space and they're going to accuse me of plagiarizing your book, because they'll be like, oh, he's just saying everything that was in Saifedean's book.
Nah, you have full permission to repeat anything that's in it, because I'm pretty sure your influence in it is prior art in this case. So but the way that things work on the internet now, everybody understands that no ideas are original. Ideas are always fermenting and growing through the interaction with different people. So I find it a bit of a waste of time to sit and argue about whose idea it was.
That's also a very good point, and especially with the open source nature of the Bitcoin code. All right, let's jump right into your book. Let's talk about a little bit about the monetary history. And you mentioned in your book that Bitcoin is most similar to the financial system of the Yap Islands, where they had these giant stones and then everything was quasi-public. Just tell us a little bit something about that, though I will run this show under the assumption that everyone else has read the book. So very quickly, we're going to jump onto a couple of things that that were not mentioned in the book to try and get, questions that other shows will probably not going to ask you.
Mm-hmm. Yeah.
So really quickly, can you just talk about the solubility concept of solubility across time, space, and wait a minute, there was time, space, and the divisibility.
Yes, so scales.
Scales, thank you.
Yes.
Just briefly mention that concept because I have actually not heard the word saleability in the concept of money and until I got to your book.
Okay, so it's a pretty important concept, and it was first articulated, I presume it is the first, yes, by Karl Menger, who is considered the father of the Austrian school. He wrote a textbook on economics called The Principles of Economics in 1870 or 71. And he's also the father of marginal analysis. So all of modern economics relies on the idea of marginal analysis. This is not just stuck to the Austrian school, but everybody understands marginal analysis, or everybody at least works within the frame of marginal analysis in economics. So one of the other concepts that Menger explained is the idea of saleability, that how a good gets to be chosen as money. And this helps us understand why gold emerged as a form of money, because it's saleable, and the saleability refers to the idea that it's the thing that is the easiest to buy and sell. So it's the closest concept to it you can understand as liquidity. In other words, it's an asset that is not hard to sell off at any point in time just because you want to sell it. You don't have to go through complicated procedures to sell it, because you don't have to find somebody who wants the asset for its own sake. Once a good emerges as money in a monetary system, it becomes a good that is just wanted for its own sake because it can be exchanged. So everybody accepts it, not because they need it, but because they know that they can exchange it with other people. So, a house is not very saleable because you need to, even though the house might be worth, let's say $1 million, you need to find somebody who needs that house in that location at that time and has $1 million lying around to buy that house, right? So there's the coincidence of need problems is what money overcomes. Money is something that people will accept because they can just keep exchanging it for other things. And so that becomes the thing that is the most saleable good. And so if you want to understand what you would look for in such a saleable good, why such a good would emerge, it has to do with the fact that it is saleable across space, that you can move it around easily. And so that makes things like houses and land not very good because you need to move them around. Saleability across time, before we get to time, saleability across scales, you want to combine it and divide it into things. So, couches or cars or large capital goods are not very good as money because you can't just divide them, and 1/10 of them is useless without the other 9/10, and who are also useless without the 10th. So these are not very divisible, and so not very easy to use for general exchange. And then thirdly, you want it to be saleable across time, that it could hold its value over time. So obviously this would disqualify goods that would rot and ruin and go bad. And it would tend to favor goods that maintain their value over time. So gold, for that respect, became good as money because it doesn't rust, it doesn't corrode. But I think over time, as industry advanced and as civilization advanced, we could make new modern compounds that have these kind of properties, or we could build complicated payment systems and banking systems that allow for the exchange of value without having to rely on the movement of physical things. What I argue is the most important metric that made gold money is its economic properties, not its physical properties. Or to be more accurate, the physical properties only matter to the extent that they shape the economic property. And that is what allows it to maintain salability across time. In other words, the other things, the salability across scales and the portability and the ability to move things around from one place to the other, these are pretty trivial in a world in which industry has advanced to where we are right now. It's not really an issue in what makes something money. What makes something money now is its ability to maintain its value over time. And I think the key reason to understand why gold and why not other metals is that gold's supply is extremely rare on Earth. It's very hard to find gold on Earth. And so if you're trying to dig for it, you're always facing increasing costs. We're always, mining at the margin of the cost of selling the gold. So mining projects are sometimes profitable or not profitable, but they're around that price margin. And the other thing is, because the supply of gold has accumulated over thousands of years, because it doesn't ruin, new supply is never that significant compared to existing supply. So if you look at the supply of gold over time, you see that every year it increases by around 1 to 2% or something like that. And that's more or less it, 1.5 more accurately every year. That's just how much it's going to increase. So it doesn't matter if during that year the price goes up a lot or drops a lot, like what we saw happen in the last few years, or like in the 1970s. Even in the 1970s, as gold went from $35 an ounce to about $800 an ounce over 10 years, still the production could not really increase beyond the 1-2% per year every year. And that's, in my opinion, what makes gold money and what gives gold its monetary value. Because with anything else, if people use it as money, the value would go up, and then people would start producing more and more of it, and then the price of it would come down. The temptation to produce more of it is always going to be pretty strong with the producers. And that could be producers of things like copper and silver, or it could also be producers of things like government money, who, eventually find a way of continuing to print more of their money because they can.
All right. Thank you for that general history. And then there was one more topic that I really like. One of my strongest takeaways from the book was your explanation how silver became totally useless as money as technology continued to progress. And that's mostly because now you didn't need silver to subdivide gold into smaller units of value. And that's what caused this historical ratio of price of silver to gold, which has always been approximately 17-1, which is similar to its geological ratios. And because of the advent of technology, gold became divisible enough as it was backing other forms of paper money. And this is how the ratio of price of silver to gold blew out of proportion. And any government attempts to stabilize that ratio during the gold standard led to some pretty bad panics.
Yes, absolutely. I think one good way of thinking of it is that silver is the original analog shitcoin. Since 1870, basically, it's had...
So Litecoin really is the silver to Bitcoin gold, right?
It's true. After 1870, though. After 1870. So before 1870, silver still was... A lot of countries were still on the silver standard, and it was still used as payments. But by 1870, most people didn't even use coins for... Well, not most people, but I would say like in Europe and in the civilized... in the advanced industrial economies, the gold standard meant that people were using different kinds of money backed by gold. And so, if you could make these forms of money divisible into small pieces of paper or whatever you want, you could pay in any quantity of gold that you needed. So that completely obviated the need for silver to be money. And then in 1870, Germany switched from the silver standard to the gold standard. And that was the sort of, the big switch that shifted how the majority of the world economy was then on the gold standard. And so then the value of silver began to collapse. All the holders of silver started to sell more of it because it wasn't very liquid anymore. And that led to just more collapse in value and more drop in liquidity. And since then, it's just dropped in value quite significantly compared to gold. So it usually was between 12 and 14 to 1. Now it's more like, I've lost count, but somewhere in 50s, 60s, or 70s, something like that. So it's lost its monetary role. And it's also, it's not as hard as gold. So there was no reason for it to serve as any sort of monetary function after 1870. However, this was a bit of a problem for the countries that were still on the silver standard, particularly China and India. The US, to a lesser extent, even though they were officially on a silver standard, a lot of the economy was effectively on a gold standard, and the banks were capitalized with a lot of gold. But the problems that they faced in the US were that when the government tried to mandate silver as money, and they passed something called the Silver Purchase Act. I think it was in 1890 something. And when they did that, it was an attempt to, it was like a populist movement that came up and said, it's regurgitated gold propaganda, which you still hear coming from Keynesians today, but something along the lines of, gold is so expensive, and so poor people can't afford gold, and so poor people can't have money. Silver is, the working man's money, and we should make silver money. And so the government should buy silver from the silver mines and use it as money and make US dollars redeemable in gold and silver. I'm a little sketchy on the details, but
this also sounds a lot like the Bcash push. It's like, oh, Bitcoin is too expensive. Bitcoin is it's too slow. It's not somehow people are like entitled, and this is the poor man's this is the working man's coin, the coin that you spend, which is ironic because if Bcash is meant for spending, no one is saving in it, and you focus a lot that the backbone of a real cash system is the savings. And you actually mentioned the word cash actually meant savings, not spending, in your book as well. I definitely caught that part. Maybe you can.
I wouldn't say that cash refers to saving in particular, but the technical term for cash is the opposite of cash is credit, and this is what I think. The problem with Bcashers in general, I think, is I've recently figured this out thanks to, I think it was Pierre who said something along these lines on Twitter, that they fundamentally misunderstand the term medium of exchange and confuse it for what is the system of payments, basically. This is what they don't understand. So they think PayPal is a medium of exchange, and this is a huge misunderstanding. If only somebody would just sit them down and explain to them, no, look, PayPal is a method of payment. The medium of exchange.
They are centralized, so this may actually be possible.
No, but the point is that, when you use PayPal, you're paying in dollars. The medium of exchange is still the US dollar, okay? If you're using your credit card, if you're using your bank account, you're paying in dollars. The medium of exchange is dollars. The method of payment is the Visa or the MasterCard or the PayPal. So they somehow are under the impression that first you need to become a method of payment. You need to become a network of payment. You need to become a PayPal. And then people will then want to hold you and store value in you. But that's just completely the opposite of how it would actually work. Because even assuming that, you managed to run a payment network that was the world's most efficient, which they are nowhere near running or coming anywhere close to. But, imagine they do run the world's most efficient payment network. Well, then anybody who needs it doesn't need to hold its own native token if the whole point is just the payment network. You can buy and sell immediately before and after. So it's not the payment network that's going to give money value, because, we saw that the most valuable payment network in the world emerged around the gold. And gold is not particularly a good payment network. It doesn't come pre-installed with a PayPal system, and it doesn't come with an app, and it doesn't have it has nowhere near the transaction per second capacity online that Bitcoin has. You can't send gold around the world. And yet the payment network was built around it because it was the store of value that people wanted to hold. That's the thing. What makes something money is what people want to hold in the long term, because in the long term, that's the only money that survives. It's what money that is invested, or money that is held for the sake of surviving for the long term. So that money is, because people want to hold it, people will find ways of exchanging it with one another, and they will build payment system on it. So once it's the store of value, once it's the thing that people want to hold into the future, once it's the thing in which the people want to keep their cash balances in, then it becomes the store of value, and then becomes the medium of exchange. So the term cash used to refer to the opposite of credit. So credit is payment that involves obligation on somebody else fulfilling something in order for it to come true. So you pay me with a check. That's a credit, or you give me a paper that says you're going to pay me in a month. I still need you to pay in a month. But if you give me the cash today, that's what it means, is that it's nobody's obligation. So the term cash usually referred to gold. When people said cash balances, they meant gold balances. When central banks spoke about their cash balances, they meant their gold balances. And money was credit money because it was backed by gold, but it was redeemable in gold. So it was credit in gold. And so this is really the distinction that they miss the point of it. Today, because paper money is what we use in daily payment, so the word cash has come to mean the daily payment that you pay, because it is cash. Whereas all the larger payments you go through your bank, they're credit payments. They involve some risk of default fundamentally, but the only cash payments that you make are in actual physical papers. So the B-cashers have confused it into thinking that this means, Bitcoins needs to be cash, and therefore it means to have 1 million people buying coffee every second around the world in order for it to survive. But it's the other way around. It's cash because it's final settlement. It's nobody's liability. That's what cash means.
Right. And I do want to jump on something I want to talk to you about, which was the concept of credit and how credit functioned under the gold standard, if it functioned at all. And what can we see going forward in terms of credit in the world of Bitcoin, if Bitcoin does one day become the Bitcoin standard, kind of like the gold standard did. I will just do a very quick screen share. I mean, I was going to talk about this myself, but my friend Ugly Old Goat wrote a review of your book, and he absolutely loved it as well. He even quoted some parts of your book that he particularly liked. And at the end, he did mention how you also talked about in your book, which part it was this here, about during that time of the 18th century, when there was some of the biggest innovation that was taking place, and we had a lot of commerce. There actually was a credit system under the gold standard. And I'm also a believer that credit is almost necessary to an economy. I find it very difficult to believe that everything can be financed, by saving first. I'm a big fan of credit, and I do credit Martin Armstrong for teaching me a lot about credit. And here's the biggest takeaway that I learned from following Martin's work and reading a lot of his material, is that credit can be broken up into 3 parts. One of them is, you have some kind of a fractional reserve lending, or you actually are printing money out of thin air fractionally. And the institutions that are responsible for this money printing lend it for business purposes, like small business loans, or they provide credit like your credit card. You're going to buy a bunch of clothes and you're supposed to destroy that debt once you get your paycheck, or once a bank loans money to a small business, the small business is supposed to improve the local economy. Therefore, the small business gets money. They then pay back the loans, and the credit that was created, the money out of thin air that was created, that money gets then destroyed in that kind of a credit system. This is what's referred to as good credit. Then there is intermediate credit, which is neither really good nor bad. This is the credit, let's say, to buy a house. You don't want to save for 10 years to buy a house. So you take out a loan to buy that house. So the house itself provides very little economic activity other than the housing sector that built that house. But basically, you are taking on debt that you're going to pay back with interest because you want more consumption now and not later. And because a loan to print money out of thin air for you to buy a house is less economically productive and will have a significantly smaller, GDP effect, and it becomes more of a neutral type of credit creation. Now, the final scale on this is the worst type of credit creation imaginable. And this is government borrowing to fund their operation, because government only sucks value out of the economy and government doesn't really create anything. So that's the type of credit that basically ruined the current economy, because the Treasury is printing the money because Congress can't live within its means. And this is why our taxes are high, and this is why we're still running deficits, and this is why politicians are promising pensions and benefits that they can't, cover. And that's why our national debt is 20 trillion. Like 70% of that is accumulated interest, because the theory is, well, if the government printed money, it would be worse. When in reality, the government is printing money that they're borrowing. So, and if the government printed the same exact nominal value instead of borrowing it into existence, the national debt would be 70% lower. But if the government was able to just print money, you can say that they would have printed a lot more and our debt would have been about the same. And the unfunded liabilities are 120 trillion. So what is your view on the concept of credit? How did it work under the gold standard? And is credit something you envision in the future under the Bitcoin standard?
Okay, so obviously, yes, in a Bitcoin standard, in an economy that's primarily based around Bitcoin, there will be credit. Credit is something that has always existed and it will always exist. Now, it's very tricky to say how things functioned under the gold standard, because, I mean, I'm just going to compare it, how things functioned under the 20th century government standard. Things change all the time. Different things happen, and different periods have different kind of institutional arrangements. And so it's hard to paint with broad strokes. Now, I read that review that you mentioned. It was pretty good. The only critical part was towards the end, that he says that I didn't really discuss the role of credit. But, in my book, it's not a book on, I did not get into the development of the capital market in a Bitcoin economy. And I did not discuss in detail the shapes of the payment and financial instruments under the gold standard. But I did say that, in fact, the key point was that under the gold standard, you had many more transactions taking place than you had actual physical movements of gold. And that is the model that Bitcoin is going to follow. So the way that it's going to happen in Bitcoin, the way Bitcoin is going to scale, is that transactions off-chain and second layer transactions are going to allow a far bigger number of people to be transacting with Bitcoin than the final transactions that are happening on-chain. And that's essentially how the gold standard functioned, in that you had gold sitting in a bank or in a central bank somewhere, and people were exchanging pieces of paper and letters of credit and bills of exchange and real bills and all sorts of different arrangements between them, making the volume of transactions much higher than the actual physical movement of gold. So the analog here is the physical movement of gold is like an on-chain Bitcoin transaction, and the movement of all the kind of other instruments is an off-chain transaction. So,
well, no, I'm with you. I'm with you on all of that. Like, yeah, I'm a big fan of Lightning Network, but that's a little different than, an institution having X amount of, claim, let's say X amount of gold or X amount of Bitcoin, but yet they're able to issue, well, right now, our current banking system is able to issue 9 times that, right? So, or 10 times that. Like, how do you think that would function? And do you think, having a 9x multiple is too much? And if it is, like, what would be a reasonable amount that may or may not be enforceable technologically? Or because I don't know if you want a law enforcing it, because nobody can know what the right amount of fractional reserve multiple can be. So you kind of almost want the market to do it, but then the market, it'll be interesting. I mean, obviously, the market. My guess is
that's why Bitcoin is really interesting, because we're going to get the market to do it, and so
and
that's why I don't like that. That's why I think arguing about this stuff is kind of a moot point, because we're just going to see it unfold in front of us.
Right. So you do envision like a credit system. Now here's the good and the bad. The bad is that when you let private people just create credit, like right now, banks are given the green light by the government that they can do a 10-to-1 fractional reserve because the government has deemed it to be safe. Clearly, it wasn't safe like for the Greece events and for other points in history on bank runs. And I will talk about the 1907 crash in a minute. And under the gold standard. So we don't know what it is, but I will say that if there isn't this, law that says you can create a fractional reserve at 10x, it'll probably at some point, if it's not happening already under the ICO standard, it's going to get way out of control to like 40, 50x, blow a giant bubble, and then nobody wants to lend anybody money. And then credit goes from 30x to almost zero. And then now the Fed intervenes and is forced to print money and lend. Like you do get these booms and bust cycles.
No. I've let you go on for too long. I have to stop.
All right, go on.
Okay. So for me, this is exactly like if you're telling me, well, what should the government set the price of apples at? Currently apples sell for $5. The government should make sure we can get them for $2. I don't know if we let the market go free, then we're just going to keep having greedy apple sellers sell their apples at $50, $100, and $5,000, and then eventually people will decide they don't want any apples, and then the market for apples is going to collapse and we're going to fall to zero. Is that how free markets work for you? No. What ends up happening is that people have supply and demand, and people take risks, and people make decisions, and people who make the right decisions profit and continue and succeed and replicate their business model more and more and become responsible for more and more of the production. And people who are not profitable will suffer the opposite fate. So in the case of banking, I mean, fundamentally, my answer is that the market will decide what's best, because that's just how the market functions. Because, if you think that 10x is safe, go ahead, start the bank with 10x and see how well that works out for you. The interesting thing about Bitcoin, and the important thing about Bitcoin, and the whole reason I care about Bitcoin, is that nobody can print it, right? Nobody can just go and say, okay, let's just make 1 million extra Bitcoins because, we need to. So if you don't have somebody who's able to print it, you as a bank need to survive while conducting fractional reserve banking without a lender of last resort. There's nobody out there that is willing to lend you. I mean, if you want to think about it in a simple, crude, figurative way, you could say there's nobody out there to print money to give you money when you run out. And that's what central banks do to banks today. But of course, it's not exactly like that. The way that it functions more accurately is that they are a lender of last resort. In other words, if a bank is facing liquidity problems and it's unable to borrow at the market at a rate that would allow it to meet its obligations, it will go and borrow from the central bank at a lower interest rate. And so...
right. The U.S. Federal Reserve was supposed to work the way you described, but that's not how it's working today.
No, that is how it works today. It is the lender of last resort to these
banks.
No.
It's a lender of last resort, but it was supposed to... I was going to get into the 1907, which caused the creation of the Federal Reserve. Or maybe I should mention it, and then I'll let you explain.
No. I want to go back to the old point, which is that the question is not very easy to answer from empirical history, because we've not really had a clear-cut example of, in American history at least, of a truly functioning gold standard. Because government always, there were some forms of, government monopoly on banking and government control of the money supply and legal tender laws and all of these things. So, it's quite likely, and what usually happens if you study the history is that there's the history story that says, things were bad on the free market and then the government came and intervened and fixed it. But then there's the other reality, which shows you that actually this time when they claimed to have fixed it, it was actually just sowing the seeds of the next crisis. So when you start reading the history sequentially, you start seeing how these things emerge. And so to go back to the question on fractional reserve banking, my solution is that, let the market decide. So then if you go and you decide to go and do it at ratio of 2 to 1 or 5 to 1 or 10 to 1, the onus is on you to survive in the market. And I don't think that is an easy thing. If I were to bet with, or what I would do, I would not want to transact with a bank that does those things, because fundamentally, without a lender of last resort, you are vulnerable to becoming, to going bankrupt. And, you could call it a liquidity problem if you want, but in a world in which there's no lender of last resort, liquidity and solvency are the same thing. If you can't make payments, you're insolvent. And if you can't make payments and nobody is willing to lend you at a rate that allows you to stay solvent, then you're as good as insolvent. So in that situation, I want you to think of it as a finance person. Think about what, say, Soros did to the British pound in 1991. If you know that this bank has this much obligations and this many assets and this much liabilities, it's possible to generate, so for you make a deposit with them that is available for you to withdraw, and then you short their stock on the free market, and then you ask for your deposit back, but they don't have the deposit because they've lent out parts of it, and now they have a liquidity crisis on their hands. The stock market price is going to plummet. You're going to be making a lot of money on the by shorting them. So it's just not a very stable thing to do, and it's not a very sustainable business model. So I personally think you would get credit. And the answer to the question of, I have to admit, I'm not familiar with Martin Armstrong's work. So, this might be unfair that I'm going by your summary of it. But, the question of what is good credit versus what is intermediate credit versus what is government borrowing should not be a macro question for philosopher kings to decide whether, you get to live in a house or I get to have a business or government gets to fight a new war. This isn't something that we need to have political scientists and economists sit and decide. The way to decide on what deserves good credit is what the people who have the savings are willing to put their money behind. Now, if it so happens that banks that are well capitalized end up engaging in fractional reserve banking and creating credit that's not backed by gold, I have no problem with it. But I think the examples that he mentions, your friend in his review, I think the better articulation of them is in the work of Antal Fekete, what he calls the real bills doctrine. And Adam Smith spoke about this. And it's how, credit would settle itself because the bank would act there as an intermediary between the different stages of the production process. And so it would extinguish the debt without there having to be any, move any physical gold between any of them, and the debt would just distinguish and the bank would get its fee from it. And I think that's a perfectly fine thing to happen on a gold standard, and it can happen. And the reason it is able to happen is that this is the bank's business. This is why the bank earns its keep. It's because the bank is able to assess the risk of all of those people and undertake the risk that if one of them breaks a leg and can't deliver, if one of them, there's a fire, the bank is standing there ready to provide real resources. And only a bank that's well capitalized and that has built enough of a reputation and a name is able to do things like that. So if it emerges on a free market, as long as the bank is able to maintain its solvency on a free market without a lender of last resort being able to bail it out, then I think that's good credit by my book, If, on the other hand, you have a lender of last resort, and that's really the problem, the mere existence of a lender of last resort is not the solution to this problem. The existence of the lender of the last resort is the moral hazard that allows them to then make those problems, issue the bad credit, and then be sure that it can be effectively diluted where everybody pays the price of it because the money supply is going to be expanded through more and more lending, effectively.
Right. And I'm with you there. And like, again, for me to push back on this, and I don't want to sound like a monetarist or a Keynesian here, for me to slightly push back on this are basically the events of 1906 and 1907. Just as a very brief history, I know for my audience especially, there was a huge earthquake in San Francisco in 1906. And the initial stories, if you go back through the history books, is that, well, the earthquake wasn't that bad. It was the fires that destroyed everything. On additional, historians have gone back through a lot of those records. I remember watching a documentary on this. It was the equivalent of Photoshop of 1906 that made sure that the fires did all the damage, because the insurance companies, which were mostly on the East Coast, not the West Coast, were aware that California was an earthquake-prone zone. And due to insurance fraud and insurance scams, a lot of the insurance companies had to pay out way more than they were solvent to do. This led a lot of capital and money to be leaving the East Coast and going to the West Coast to basically rebuild California. And that caused a lot of maturity mismatching. This was all under the gold standard in 1907. So banks had a lot of people's deposits. I don't even think that there was that much credit in, and it wasn't that much of a fractional reserve. But the mere concept of maturity mismatching, of taking in deposits and telling people they can have it on demand and lending that money out at, a longer time maturities, this is how the banks ran into huge problems in 1907, causing what perhaps was even a bigger crisis. 1929 and 1930s was probably bigger, but it was it was pretty much equivalent to the 2008 crisis with real estate. Only over there, it was also quasi real estate, quasi insurance, because of all of that and all those demands. And there was no central bank, there was no lender of last resort. And J.P. Morgan, who was still alive at the time and running one of the biggest banks, basically the bankers were coming up with the money themselves because the New York Stock Exchange was going to fail. Again, according to the records, the head of the New York Stock Exchange called J.P. Morgan and said, we have to close the exchange early because there's like a run on like the stocks. And he thought that was crazy. He thought that the confidence would be lost even more, and the crash would get even worse. And they had to bail out the system themselves, the bankers. They had to come up with the money, personal money, whatever, to bail out the system to bring that confidence back. Those events led those same bankers to try and come up with a private, independent a lender of last resort only in times of crisis. And its only job was to capitalize the private sector. It wasn't supposed to have anything to do with the public sector, just the private sector. This way, the banks would have that liquidity in case of another black swan event. And then due to the events of World War I, the government intervened and they forced this Fed at the time to now start buying government bonds instead of only functioning. It was going to be financed by the bankers. It was going to be like their own insurance fund with the intention of capitalizing very necessary industry, mostly the financial sector. And that's how we got the current Fed, because the government wanted more and more control. And it was originally going to be 12 independent, Fed liquidity providers. And they would set their own interest rate based on their region, even for, let's say, grains and crops, where during certain seasons of the year, certain parts of the country needed more liquidity because they were growing crops, and then they needed less liquidity because people are actually paying for those crops when they're due. And then these banks would kind of compete with each other for interest rates in those regions to make sure that capital is kind of flowing evenly. And now you can disagree with the original system of the Fed and why it was created, but it's nothing like we have today, because now the government pretty much sets the leader and the government controls it. And then the government gave it a ridiculous mandate of somehow being responsible for employment and setting one interest rate instead of these institutions competing for interest rate within regions. So there's a lot going on there. I don't know if you want to comment. Other than that, we're going to move on to the potential Bitcoin standard. So floor is yours, Saifedean.
Yeah, so I'll just say, I mean, the sort of way that I see it is that whatever emerges as a banking monetary system in a free market is good, if it is really a free market. The problem is here, I don't know how much I buy the Martin Armstrong story that it was just a free market institution and then the government co-opted it, because it's almost impossible for them to have gotten the Federal Reserve without government monopoly. You see, the question is...
Right. They had to get the idea of it passed because the Andrew Jackson had eliminated the prior version of this, which was way more centralized and owned by the government.
Yeah, so I mean, you can't really say that this was really a free market institution. A free market institution wouldn't need a government stamp. And the reality is...
I'm not saying this was totally free market, but it was supposed to try and function generally outside of government control and interference.
I mean, that sounds, I mean, maybe it's 100 years later, it sounds more naive than it did. But I think even in 1914, it must have been completely naive to expect that, we're going to set this thing up and have the government enforce a monopoly for us. But, they're going to play nice and not use this for political aims. Of course, the governments are always going to find this wonderful meal of money printing.
I agree with that. And all of them learned it real quick.
Exactly. So it's kind of a moot point at this point. What matters is this: we're witnessing this new emerging system that is built so that it can't really be centralized and co-opted, and that's going to begin to flourish amongst people who are not too keen on the idea of accepting paper substitutes for things. And, I think the shitcoin standard is going to teach a lot of people that lesson the hard way, the people who have still not learned it. That's really why the shitcoins really exist. So I think the question that I asked to Professor Larry White, who's written a lot about this, Professor Larry White and George Selgin, they would argue that, in a Bitcoin economy or a Bitcoin standard, you would get fractional reserve banking. But we've still not seen any fractional reserve banking in the Bitcoin economy. And I would wager to say that I would not expect them to succeed. And in fact, the closest thing we have to them are Mt. Gox and the Ponzi schemes that have collapsed. And I don't think you can really find a very strong difference in principle between these things and fractional reserve banking, the way that I see it. So I'd be surprised if they survive in a free market, but we'll see.
I agree with you. We need a lot more value on chain. I mean, Bitcoin would need to be at least as, Bitcoin would need to be by market cap at least as much as gold back in the days when it was that backbone, right? Like, correct, Mt. Gox had no chance of running a fractional reserve. But when one Bitcoin is upwards of a few $100,000, maybe even one Bitcoin is over $1 million, you can then, I can then picture certainly lots of these financial institutions running a fractional reserve by only holding a few hundred Bitcoin or let's say 1,000 Bitcoin, and they're running a fractional reserve because now you basically your run on the bank is a lot less probability of that because you still have those fat tails, but you're spreading out. A rumor, for example, will not cause a giant liquidity crisis on an exchange if it's a rumor. We need something a little more substantial. So yes, I don't see this anytime soon, but in the future, I can certainly see it.
So what I would say is, I would expect that there would be some sort of degree of fractional reserve, if only from the fact that, banks can just effectively monetize their reputation and name as if it was a reserve, because it is a capital good. And so, a bank, you could, because of the convenience and the safety of dealing with your bank, for instance, maybe you could have the bank run a 95% fractional reserve banking and it'll be fine. But the question then becomes, what is too much? So 95, why not try 92? Why not try 85? And then, effectively, the way that I see it is that with Bitcoin and with the transparency of the blockchain, and with the ability of everybody to see every single coin and its how coins are moving and how each financial institution's balance sheets look, I see no reason why the fractionally backed coins won't trade at a discount. So this is the way that I see it. You'll just have a discount. If your coin is 70% Bitcoin, then your coin is going to trade.
Right, but you're also assuming that people are going to be rational and they're actually going to, investigate which bank is doing what under the hood, which they're not really doing now anyway.
I mean, look, you could say the same thing about airlines. Are people investigating everything that their airplane engineers are doing? No, but the market builds institutions that provide for mechanisms.
There's kind of regulation there. That's I don't know if you want to have that argument, right? There is kind of there's a bit of regulation there that is almost global on checking your airplane and before it can take off.
Yeah, but I mean, really, if regulation depended upon the goodwill of government officers, there'd be airplanes crashing everywhere. Airliners don't want to crash their airplanes, and they know how to handle their airlines and make them safer better than any regulator can.
Yeah, no, I do agree with that. All right, so let's move on a little bit. There's one more topic I really wanted to cover. So you also mentioned in your book that Bitcoin could, like central banks, should start considering buying Bitcoin and holding Bitcoin in their reserves in order to provide more confidence. And you see the world heading that way. And you also described some game theory ideas, like for the first central bank to do it, and that would, make other banks think. Now, I have a bit of a difficulty with this because remember, if central banks, and you foresee a future where Bitcoin is the settlement system and all of these banks are having, holding on to that Bitcoin. Now, holding Bitcoin is not exactly like holding gold. That Bitcoin can be hacked, and that Bitcoin could be stolen internally. Like I don't see that happening anytime soon, that a central bank of any country knows how to properly do security of that Bitcoin and not have it stolen, creating even more or creating even less confidence in that country.
Yeah, well, first of all, I mean, I don't say that central banks should get into this. My book doesn't provide policy advice. I'm not, this wasn't commissioned, this wasn't a study commissioned by a central bank where I was trying to look at things from the perspective of the central bank. I was just explaining that Bitcoin's ability to be cash, to be digital cash, to provide final settlement, makes it comparable to the kind of monetary assets that are held by makes it comparable to the monetary assets that are held by central banks. And so the question then becomes, if central banks start using it, then likely it will cause a run by other central banks to want to use it, because if one central bank begins to use it, you would expect that it would cause a rise and appreciation in its price, which would make it even more attractive for other central banks. And then it becomes like a game of musical chairs where everybody wants to be the first, or at least to adopt it as early as possible. That's one potential way of looking at it. But no, you're absolutely correct in terms of the security and stuff. And this is why I keep saying, Bitcoin is not the iPhone of money. It's not going to be this amazing new technology that is easy and smooth, and that, people are going to adopt it because it's just so wonderful and so much easier, in the same way that the cell phone has made your life so much easier than owning a fax machine and a printer and all that stuff, and buying a newspaper. And it's not exactly like that. Bitcoin is not easy to use. Bitcoin is extremely responsible. And I mean, Bitcoin requires people to be extremely responsible when they use it. And so I'm not entirely sure that it's even good advice for most people to be buying Bitcoin. I certainly took a lot of time before I was able to understand what was going on and how to hold Bitcoin, and to think that I could maybe make a little bit of an investment into it. And I advise people, and I don't regret it. I didn't invest early, and I didn't make a lot of money from it. But I think if I'd invested any earlier, when I didn't really understand what was going on, I would have likely done something stupid with my coins and lost them. So my answer to central banks, like with people, is, the real challenge here for you is not to just go and buy some. In fact, if you just start by buying some, it's kind of a pretty risky and stupid thing to do. The real challenge is for you to understand how it works and to figure out what it means and how it operates. And then if you find yourself capable and willing to be able to hold it, then you're gonna then maybe think about it. But the point is that, as I was telling you earlier, it's not the ease of use that's going to make Bitcoin popular. It's the fact that it is hard money and it's going to force people to learn how to use it. Now, it might just be the case that we end up with some degree of centralization because of the fundamental scaling capacities of Bitcoin, wherein, it will definitely be the case that Bitcoin is not going to succeed if it necessitated that every person has their own node and for their on-chain coffee transaction. I mean, that's tens of billions of transactions every day that you would need to have your phone recording every second in order for you to be able to process other people's payments. So there's going to be some degree of vertical scaling. In other words, the blockchain serves as the final clearance, the settlement, and then second layers come along. And I think in terms of security, that sort of what we're going to see is that the higher layers of things that are going to involve banks and financial institutions will involve a much higher degree of competence, and security in transactions, so that it's not going to be anybody who can just send an on-chain transaction, because it's going to be costly and you're going to need to go through some. We'll develop software and maybe even hardware infrastructure that's going to make these things more doable on an institutional scale, solving custody in a way that's reliable. It's risky, but it's not impossible. It's an engineering problem, and we've done far more impressive things than find reliable solutions for securing private keys. So at that higher level, you'll find very sophisticated solutions for on-chain transactions. But then, as for the individual user, the experience might differ in that you won't be required to maybe remember your own private keys for individuals. I mean, some people will have the option of being able to use Bitcoin without having to do those things, which is what you see happening right now. A lot of people have their account on Coinbase or these exchanges. They don't keep addresses, they don't keep private keys. And so maybe that's going to grow more and more.
Okay. So my final question on this, and then I do want to. Okay, so I have two more topics. My final question here, and then I want to talk about the economics of like Bitcoin itself and its inflation, deflation of coins. But before that, so I'm already picturing, like the next 100 something years. Let's say the next 200 years. Do you see like history repeating itself, as in eventually, let's say the Bitcoin does become the de facto gold standard of the 17th, 18th century. And then, like you mentioned in your book, the majority of that Bitcoin ends up at these central banks using as the underlying settlement, kind of like what happened with gold. And even though Bitcoin is easier to transfer, so that like gold, that was one of the challenges with gold, then you have this fractional reserve system built on top of it. Then some president declares that Bitcoin is now illegal and you're supposed to turn in that Bitcoin. And then they peg their currency to Bitcoin. And then eventually they remove the peg, and we're back to the same world 200 years from now. Like everything pretty much repeating.
Well, I'm not advertising Bitcoin, so I'm not going to make any warranties. And don't write me complaining. I didn't invent Bitcoin. I'm not telling you to buy it. So if that does happen 200 years from now, your ancestors shouldn't blame me. Now, but more realistically, the way that I see it is that this is an excellent question, because it really hits at the core of why I think Bitcoin matters and Bitcoin is important, and why it's different than gold, and why somebody who's a gold bug like me, who was who understood gold as money and had the Austrian perspective, started to take Bitcoin seriously. And you have to understand that, before I get into this, just a small little aside, from the perspective of Austrian economists, the last millennia of human history have just been the same story of people coming around saying, oh, look, we found something that's better than gold and we're going to do it. And, every time, Keynes is just the latest in the long line of charlatans who have come up with their own story for why their stupid bullshit is better than gold. And this has been going on for thousands of years. And, all of these people are forgotten and gold continues as money. So this is naturally the skepticism with which I dismissed Bitcoin for the first few years. Okay, so you have to understand that me coming around to seeing Bitcoin as being anything more than just another stupid digital alchemy scheme took a lot of time.
Right. It's confidence in the underlying technology. Everybody forgets that.
Yeah, it took me a lot of time to understand the technology and figure out how it works and figure out the security and the cryptography and all of that stuff. I still don't claim to understand it all, obviously, but enough to think that enough to start being skeptical of my skepticism. I would put it that way. So I think the real reason why Bitcoin is, why it matters in this regard is that it doesn't have any of gold's physical properties, which are pretty and nice, and many gold bugs obsess about them, but they're completely irrelevant to gold's monetary role. But what it does have is that it is the capability of sending Bitcoin around the world is far, far higher than with gold. So with gold, it naturally meant that as the world became globalized and connected, we all email each other. Well, not even email. We have telegraphs and we communicate with each other and we trade all over the world. You need to send money all over the world. Sending physical gold just became impractical. So the only way to do it was to rely on credit instruments around centralized gold reserves or the gold standard and bills of exchange and all of these other things that developed that replaced the physical movement of gold with trust in intermediaries. Okay. And that necessarily at the end led to a world in which we have something like 50 central banks and then eventually 200 central banks that are effectively just one central bank, because you're just not going to be able to move gold around easily every day. Bitcoin, as it currently stands, as it is currently operating, has the capacity to do about 500,000 transactions per day. And we know that as a sort of bare minimum. And I'm just saying this as just what we see as raw transaction data. If you actually think about the number of payments batched into these transactions, it's larger than that. But even taking this sort of number, and it can increase through many small innovations that can happen over time. But even with that sort of number, it means that you can have a system where, unlike with gold, where you have one central bank in the world, with Bitcoin, you can have something like 1,000. And also, they are each individually dispensable and not essential to the operation of the system. In other words, it's like BitTorrent. You can't just go and shut one of these banks down. If you shut one down, there's still another 1,000 or 5,000 or 10,000. So the reason that I don't think it can happen, or that it would be much harder for it to happen with Bitcoin, is that the nature of the asset not being physical means that moving it around is far easier. And the nature of the asset being secured by cryptography means that defending its ownership is far easier than it is in the case of physical stuff. If you have gold, okay, fine, you can keep it buried under your backyard, but good luck sending it to halfway around the world if you're trying to migrate. Then it gets complicated. Then it's hard to hide. Then it's hard to move, and it's hard to send. So Bitcoin has that ability to make it elusive enough and decentralized enough that it's going to replace the head of the snake, essentially, with an unlimited number of Hydra heads that just keep springing up if you try and attack them. That I think the system is quite resilient, and it has a good chance of continuing to survive for a while. I'm not saying, listen, I mean, I don't tire of repeating this. My book is not an advertisement for Bitcoin. I don't want you to buy Bitcoin. I don't care if you buy Bitcoin. I don't, I'm not trying to ask people to believe in it. This is what I see as the economics of Bitcoin. And I think there's a significant chance that it is workable. And I think this is really the advantage that it has, that the peer-to-peer network might just be even more valuable than what Satoshi Nakamoto has even imagined. Or maybe he did imagine, but he didn't really discuss it in this way. But it might just be that, or maybe he did discuss it that way, but it just might be that the value proposition here is not in replacing your own payments or even replacing large money transfers. It's in securing a global network of central banks that is completely run on electricity and zero politics. And that might be just the astonishing invention that Satoshi Nakamoto has found. Just get your entire global monetary system to the transfer of value now is completely separated from politics, and it's just purely a matter of electricity.
So as a follow-up, what would be the role of a central bank in that world? Because we talked earlier about, they wouldn't be able to, print money out of thin air and recapitalize governments nor countries. So what is the role of the central bank? Simply provide security for Bitcoin?
I mean, I don't really see a role of a central bank anymore. I see a role for banks. I think the fundamental and I say this, Bitcoin doesn't compete with banks, it competes with central banks. So you would get a world in which the central banking layer is replaced by the Bitcoin blockchain, and then you just have banks, or maybe it'll be central banks, but most likely they'll be like individual banks. There'll be free market entities, and their job will be, you can call them central banks or banks, whatever you want, but their job will simply be the traditional legitimate function of banking, which is deposits and credit. And that's what they can do. So they will take your savings and they will invest them in my business if they find that your risk profile is similar to what my business provides. And that's their job. They oversee all of the business opportunities that they can get their hands on to look at. They evaluate them and they get all the credit, all the savings from people, and they allocate savings to where they think they will be more productive. And the more successful they are at their allocation job, the better they get at it and the more profitable it becomes for them. And the second one is deposit. I think deposit is something that most people will still value. It might fly against the ethics of or the ideas of many Bitcoiners who want to have sovereignty over their own money. And I think that's perfectly fine. But I think, a lot of people don't want to have don't want to have the responsibility of having all of their wealth stored with them. They don't want to have the security risk and wealth. And it's completely understandable. And I think it's only a matter of time that we're going to see more and more of these solutions evolve that would involve, multi-sig or things like that will involve some degree of having somebody else needed to help you with the processing of your Bitcoin, just so that you don't lose the password to it.
Bitcoin security is not easy at all, and people are learning that, as we already discussed. All right, so we're coming up in an hour soon. I do want to throw something else at you. So are you familiar with Peter Todd and his general presence in the crypto space?
Yes, for sure.
Okay, so I saw him back in December. We were both at LaBitConf in Colombia, and we got to talking, and he had a couple of interesting things to say about like the economics of a Bitcoin emission to miners. And we had this discussion, and he pointed out to two things. I want to give him credit for putting this into my head. So one of them was the fact that this halving period every 4 years has two potential economic problems, and I wanted to get your take on it. One of them is like on 1 minute, your mining operation is making X amount of money, and the next minute, your mining operation is making X over 2 amount of money. And it's a huge shock to the system by having a 50% cut in your, the newly created Bitcoin that is funding your operation. And he was saying how, man, it would have been really nice if it was always, let's say, 50 Bitcoin per block or 100 Bitcoin per block indefinitely, because in 20, 30 years, what's an extra 100 Bitcoin? It's still decelerating inflation rate, but at least your mining emissions are staying constant for better management of that entire network. What are your thoughts on that? I'm really curious.
So I mean, the way that I see it is that if you kept the reward going at 50 or 25, or with the halving or without the halving, it would look the same fundamentally in the long run. In 100 or 200, 300 years, it's just going to be. I mean, the number will change obviously, but the increase is going to tend towards zero, because after a while, the 50 coins per 10 minutes are going to be completely trivial. They tend towards zero compared to the supply, because the supply continues to grow.
Right,
So,
right. But for the more immediate future, because you do like I mean I'm a half my channel is focused on predicting the price of Bitcoin, and there are huge distortions in the Bitcoin ecosystem when these halving days take place. Not to mention everybody and their mother talking about it for like for a year leading up to it.
yeah, I mean, it's the best advertisement. Also, it's one other form of advertisement. No, I think look, it's if you had no halving, then I think the difference would be that Bitcoin's adoption would have arguably slowed down quite a bit, because right now the growth rate, and I remember somebody had sent me one of these Peter tweets, and I see where he's coming from, but I think I don't have the numbers on me right now, but I think the inflation rate right now would have been around 10% per year or something like that, maybe 15. So imagine at this kind of level of production of new coins coming onto the market every year, the price would have been much lower, and that in turn would have probably made far fewer people interested in buying it. Although then again, maybe
Well,
you wonder, maybe that would have made the growth in the price a little bit more smooth, and then that
right,
would have made
and also on the
buy a
flip
little less
side,
crazy.
a lot of people are very upset that they think that it's too late to get into Bitcoin. All the Bitcoin has already been mined, and it's
Yeah,
already in
sure.
the hands of the bad people, according to them.
Yeah, that's one way of looking at it. But I mean, it's a moot point, obviously, because we can't really change anything about it. But
Right.
in terms of
Agreed there.
yeah, but in terms of the effect on miners, this is where I don't really see it as being all that significant, because miners know fully well that it's going to drop by half. But in fact, it actually ends up working out very well for them. So if you look at it, mining has been very profitable after the halvings. Ironically enough, the reward drops by half, but then the price shoots up by more than double, and mining ends up being more and more profitable. I think you can sort of see that in in looking at the data for difficulty and so on. So it's quite likely, but I don't think it's that big of a problem, this uncertainty, because mining is involves a lot of uncertainty, and buying Bitcoin involves a lot of uncertainty. So people getting in, if you're looking for steady, reliable returns, then you're in the wrong business. You should try, I don't know, sewing sweaters or something. Bitcoin mining is not for you.
Yeah, no, I always say like buying your first Bitcoins will be one of the hardest decisions uh, you will ever make in your life. And whenever people ask me when is a good time to buy Bitcoin, I always answer yesterday was. Uh, it's my standard answer,
Yeah.
unless you understand markets and trading. All right, Safe. Thank you so much. We are coming up on an hour. I promise you that we will only spend 1 hour here. And thank you so much for coming on. Tell my audience where they can follow your work and what your book tour schedule looks like, where they can come and bring their copy and get it signed by you, perhaps.
Yes, absolutely. So my book is the Bitcoin Standard. You can get it on Amazon and possibly some local booksellers around you. You can find me on Twitter. Saifedean is my handle, Saifedean. And I will be in Calgary in the Bitcoin Rodeo on July 9th, in Montreal and Startup Fest on July 10, and in Dallas for the Bit Block Boom conference on July 14. in case you are around and interested, you can use my name as a coupon and get a 50% discount on the ticket for that conference. So it's BitBlock Boom. And if you use my first name, Saifedean, then you can get a 50% discount on tickets for that conference. I'll have a bunch of books and you can bring your book for me to sign if you're interested, or you can come and abuse me and tell me how I don't understand how your ICO is the best.
Oh man, are those increasing or slowing down? Because it's really bad. Like, I don't know why people still try to convince me that their ICO is different.
I know. I think I'm getting to a point where, people just realize, no, that this is a losing battle. They're just wasting their time. They have much better targets than me. Somebody the other day in Charlotte, North Carolina, asked me, if I send you my white paper, would you read it? And I said, absolutely not. Even if I live to 1,000 years, I would not read another white paper for another ICO coin.
Yeah, that's exactly what I've been saying. Like, I'm just being honest with people. Like, I'm sorry, I don't have time to read any more white papers. I have read enough.
Yeah.
And I've seen enough.
And I'm happy missing out on the next Bitcoin if it comes along.
Exactly. That's exactly what I've been telling people. Look, I am perfectly...
I've bought enough lottery tickets to just find another way of...
Look, I've made a lot of mistakes since joining Bitcoin, the ecosystem in 2013, and I regret a lot of them. I wish I had a time machine to go back and fix some, but I never regret getting in earlier. Like, I'm sorry, I knew about it earlier. I didn't get in. That was a conscious decision. I've regretted what I've done with my Bitcoin, and I wish I had a time machine to reverse some of those dumb decisions. But hey, there's nothing I can do. You get in when you get in. You get in when you realize what it is. That's it. Exactly. And I am willing to miss out on the next one and for the first few years. And what I tell people is, you fail by succeeding. If your altcoin manages to dethrone Bitcoin, it tells people that their store of value is not actually store of value in any blockchain. And like, you fail the ecosystem by succeeding.
It's just, honestly, if you have a business idea or for anything, and it involves creating your own currency, it's safe to assume that you don't have a good business idea at this point. So many thousands of people have come up with, we are going to run this, blackjack and hookers on the blockchain, but we need our own currency, And at some point you realize it's really not about the blackjack and hookers. It's about just issuing your own currency. And if your project involves issuing your own currency, sorry, I'm not interested. The world already has enough, and I'm not going to waste any more of my time on these.
Oh wait, and finally, your audio podcast. You're gonna start a brand. You're gonna start a podcast. It's gonna be only audio or video audio.
It's going to be basically a collection of all my audio at appearances and all the talks that are publicly recorded, and I'm just going to be posting them onto
the Bitcoin Standard podcast, right?
Yes, which and that's eventually at this point I'm doing so many interviews that that's going to fill it up. But then later on, maybe I'll start doing original.
Yeah, that's exactly how I started. I was on so many other people's YouTube channels that eventually I'm like, you know what? It's time for me to start my own, though I still do lots and lots of interviews. So that would be great to see you. I would love to have you on another one of my streams. I would love to have you in. Now that I've brought back Crypto Scam, I would love to have you as a guest talking about one specific topic. So hopefully I can have you back on again when your book tour, kind of starts to slow down. I can grab you for an hour, and we'll save the crypto carnivory for a future podcast as well. I'm actually dying to do that one.
Fantastic. I'm looking forward to both.
Awesome. Thank you so much, Saifedean. And this has been another episode of On the Record. I was very happy to interview my guest. And because I forgot to do it earlier, I'm just going to close out with the following screenshot, which is a little tweet storm by Saif, which is how I actually discovered him in the first place. I mean, I've seen him on Twitter before every now and then, so I'm not going to read it out loud. Sorry for my audio listeners, but This was a great tweet storm. You explained why you are a bigger maximalist in Bitcoin than I am. And I will say that I learned a lot from your book. Most importantly, I slightly underestimated, and I probably should have talked about it in the interview, so I'll just mention it. I underestimated the gold standard influence on Bitcoin. I always saw Bitcoin as more useful as unconfiscatable value and censorship-resistant value transfer. I put those way ahead of having this deflationary currency, this 21 million Bitcoin that cannot be changed or altered. I slightly devalued that, and you made me change my mind on that a little bit. And I really should have that attribute of Bitcoin on equal footing. Because this is a little harder to explain than unconfiscatable and censorship-resistant value transfer, I will continue to refer people to your book in order for them to fully understand that, because it really did take you 7 chapters to fully explain the concept as to why gold has been money for thousands of years. So on that note, I will close out this On the Record episode with Saif. Thank you so much for joining me. And all of the links that he mentioned, how to find them, and the book, they're all in the video description. So go ahead and check that out. And I will see you guys soon on my next podcast. Bye, everyone.
Bye-bye.